So my name is Anjum Hajat, and I'm going to talk a little bit about payday loans and pawnshops and how these types of things are linked to health. And so I will start off with a little bit of background, because I'm going to make an assumption that not everyone's super familiar with this. So fringe loans are short-term, small dollar loans. There are things like payday loans, pawnshops, car title loans. These are all examples of fringe loans. And the thing is, they tend to charge extremely high interest rates. So we're thinking here in the realm of 400% to 600% APR, so pretty astronomical. So the issue here is that the people that use these loans, in general, they don't really have a lot of options, right? They don't have great credit, so they can't go to the bank. There are just not many options. So they turn to this fringe loan sector to meet their needs for credit. The other issue here, of course, is, as you can imagine, that fringe loan users tend to be more marginalized. Historically, they've been excluded from mainstream financial services, and that sort of has been the case up until this point. So our most recent data show that about 8% of U.S. households have used a fringe loan in the past year. So I just want to give you a little bit of reference. So compare that to what credit card you might be walking around with today in your wallet. You shouldn't be paying, I'm guessing, more than a 13 to 20% interest rate. So clearly, really dramatic differences here in what's going on with the type of credit that some segment of our population is getting. So many reasons for why people are using fringe loans. There's several of them shown here on this graph. But an example of sort of how this works in practice. So for example, an individual has a problem with his car. His car breaks down. So he goes out to the payday loan place and says, all right, I need a loan for about $400 because I want to get my car fixed so I can get to work. So within 2 weeks, so this is one of the issues with these loans, is they're very fast turnaround. You have to make your first payment within 2 weeks, which, even for credit cards, you still get a month, right? So you have to pay at least the interest. And in this particular case, the interest was $45. So when you calculate that out, it's about 300% APR, right? So it doesn't seem like a vast sum of money, $45, but clearly much more than what most of us pay. So the issue here is it really starts this cycle of debt, right? So many fringe loan users, they'll start with one, but they can't pay that off, so they have to get a second one to pay off the first one, and then this sort of goes on and on and on. And some data have shown that the fringe loan users tend to take out 5 loans to pay for that very first one. And the time frame in which it takes them to pay this off actually really becomes prolonged. So it's like a 6-month process to pay off this $400 loan, for example. So you can see sort of the dilemma that people are in. So obviously they need the car to get to work. If they don't have the car, they lose their job, right? These are not jobs that have benefits and that are flexible and allow you to sort of miss a couple days, right? You usually will get fired, generally speaking. So if you don't have a job, you can't pay your bills, et cetera, et cetera. So clearly, the option of using this fringe loan is very attractive to some people. So what we were doing here in the research and bringing this back around to health is to really evaluate this association between people who use fringe loans and their health. So there hasn't actually been much research in this area, but you can think about fringe loans as clearly a big source of debt. And as both Jesse and Wendy alluded to, one of the reasons we think that debt causes poor health is because of the stressful nature of it, right? And there's a fair amount of literature out there to show that stress is sort of one of the ways that things in the external environment really become embodied and impact our health in a negative way. The other way that this could possibly work is also something that Jesse touched on, is material deprivation. So you can think about food insecurity, neighborhood conditions being poor, as well as sort of poor housing choices if you just don't have a lot of resources. So 2 potential ways that these types of services can be linked to health. So we did a study where we found a data source that actually had data on both. This was not an easy thing to do. It's actually quite hard to find people that are doing financial work actually thinking about health and vice versa. But we were able to do that. And the results of the study were sort of, I think, as one would expect. Fringe loans are indeed linked to poor health. So our data showed that fringe users were about 38% more likely to report poor or fair health compared to non-users. And here we really did try to make sure that the users of the loans and the non-users of the loans were as similar to each other as possible. So we matched on a whole bunch of characteristics. They were similar ages, similar genders and race, similar income levels, importantly. So a lot of different things that we tried to do to make sure that we were making a fair comparison. So although, I don't think the results of the study are too surprising, I think many people would expect that. I think what's really exciting about this work is the many policy implications that it has. So I'm going to go through and talk a little bit about policy and different things that we can be thinking about sort of broadly in society as ways to sort of deal with issues around fringe loans and economic instability more broadly. So the first thing that a lot of people will think about is regulations. So in fact, there are many state-based regulations out there. So it's very much a state-by-state picture, as you can imagine. So some states have capped you cannot charge more than a 36% interest rate, for example, on these types of loans. And although that is a very useful first step, the problem here is if we were to sort of shut down this industry altogether, we are leaving people sort of stuck, right? They have no credit sources whatsoever. Again, they can't go to the bank, and if we close this down, they can't access credit that way either. So again, thinking about, although I think, regulations are a step in the right direction, it's not the only answer. We need really a much more multi-pronged approach to solving this problem. So the second potential policy solution is to think about alternative financial institutions. So here we are thinking about things like bringing back a postal banking system, which in the US many years ago, we used to have a very vibrant postal banking system. We can think about municipal banks. This has been something that's been floated by some politicians of late. And also getting credit unions to sort of provide these types of loans. So, the banks will tell you, well, it is just simply not profitable for me to provide a loan to low-income folks because they often default, they don't have great credit, right? So there's no financial incentive for a mainstream bank to do this. So taking that financial incentive out of the picture is potentially something we can do with thinking about alternative approaches here. But really, I think, in terms of the policy solutions, we need to think about addressing the root causes, right? So the core of the issue here is financial instability, right, and scarce resources. People just are not making enough money. The low-wage jobs we have today are just simply not cutting it, right? So social welfare and labor policies are definitely one thing that we should be exploring, and we are exploring clearly here in Seattle with the Fight for 15. So minimum wage is being explored by many folks on campus as sort of to try to understand if these changes that we've been implementing in terms of the minimum wage have actually had any impacts on health. So stay tuned for more on that. But in addition to minimum wage policies, so California, for example, has been floating ideas for how to create a universal basic income program. As well as to sort of expand their earned income tax credit. So the EITC is one of the largest poverty alleviation programs in the nation today, actually. So, definitely some promise there. But in addition to income, I just would like to note that the other really important piece here is wealth and asset building. So there is a difference between income and wealth. Income is what comes into the household, and wealth is sort of your rainy day fund, right? Your fund for when something potentially goes wrong. It's your stockpile of funds. So we have in this country a massive gap in terms of wealth by race. So recent data have shown that African Americans have about 13 times less wealth compared to white households in terms of net worth. So clearly very large racial gaps in terms of wealth, and there's many historical reasons for this. But over time, we've seen certain policies that have actually helped to really continue the inequality. So thinking again about ways to dismantle those types of inequality are going to require real action on our part and not really just sort of allowing for market forces to sort of help alleviate the problem. So just some thoughts around policy solutions, but I'll stop there and happy to talk more about this later.